On a small island in the Pacific, people once used money that could weigh more than a grown man. Some pieces were carved from limestone, shaped like enormous wheels, and transported across open ocean. One surviving example in the Smithsonian weighs more than 160 pounds. It was not something you slipped into a pocket, carried to the market, or tossed onto a counter. In fact, the largest stones often did not move at all. When ownership changed, everyone simply agreed that the stone now belonged to someone else. Think about that. No wallet changed hands, no metal was exchanged. The money stayed exactly where it was. Only the story of who owned it changed, and somehow that was enough. It sounds primitive until you remember what happens when your salary arrives today. No truck delivers a box of dollars to your house. A number changes inside a computer, your bank updates its records, and you accept that you are now richer than you were 5 seconds earlier. The giant stone and the banking app look completely different, but they run on the same invisible fuel, trust. And that may be the strangest truth about money. Money has never really been about paper, metal, shells, stones, or numbers on a screen. It has always been a shared agreement, an agreement powerful enough to build cities, start wars, crown kings, destroy governments, and decide how most people spend nearly every day of their lives. But the story did not begin with coins. It began with a problem. Imagine a farmer thousands of years ago who has grain and wants a pair of shoes. The shoemaker might accept the trade, but only if he needs grain at that exact moment. If he wants meat instead, the farmer must find someone with meat who needs grain, make another trade, and then return before the shoes are sold. Economists call this the double coincidence of wants. Normal people call it exhausting. As societies became larger, people needed something others would accept even when they did not personally need it. And humans became extremely creative. Across different places and periods, people used salt, grain, livestock, beads, feathers, metal tools, and shells as money. The object did not need to be beautiful. It needed to be recognizable, durable, difficult enough to obtain, and accepted by the next person. Cowrie shells became one of history's most successful forms of money. They were small, portable, hard to counterfeit, and visually distinctive. They circulated across parts of Africa and Asia for centuries. In ancient China, cowries became so closely connected with wealth and exchange that simplified shell shapes appeared in written characters associated with money, buying, and value. A shell had no magical financial power. It worked because people expected other people to accept it tomorrow. That expectation turned an ordinary object into purchasing power. But shells had limits. A growing kingdom needed to collect taxes, pay soldiers, and trade across long distances. Weighing metal was better, but every transaction created another problem. Was the metal pure? Was the weight accurate? Had someone mixed cheaper material into it? Around the 7th century BC, the kingdom of Lydia, in what is now western Turkey, introduced stamped pieces of electrum, a natural mixture of gold and silver. The stamp mattered more than the shape. It represented an official promise that the piece had an accepted weight and value. Instead of testing a lump of metal every time, people could recognize the authority behind the mark. Money was no longer only valuable because of what it was made from. It was also valuable because someone powerful certified it. Of course, once rulers discovered that people trusted stamped metal, some discovered a tempting trick. They could reduce the precious metal inside the coins, mix in cheaper material, and produce more coins from the same amount of gold or silver. The ruler gained spending power. Everyone else received weaker money. Long before modern central banks or economic reports, governments had discovered one of finance's oldest temptations. Create more money now, and let someone else deal with the consequences later. But metal coins had another problem. They were heavy. That sounds minor until you are trying to move a fortune across a country filled with bad roads and excellent thieves. In China, merchants began using paper certificates and deposit receipts to avoid carrying large quantities of coins. China became the first country to use paper money, with early forms appearing around the 7th century. This must have seemed absurd at first. A metal coin could be melted, gold could become jewelry, but paper could tear, burn, or become useless in the rain. Yet paper had one enormous advantage. It was easier to move than metal. The paper represented value stored somewhere else, or value guaranteed by an authority. Once enough people trusted the promise began circulating as money. The object became less important. The record became more important. That same transformation appeared in England through tally sticks. A debt could be recorded by carving notches into a piece of wood. The stick was split lengthwise, leaving 2 matching halves. Because the notches had been carved before the split, the pieces could later be placed together to verify the record. It was an early anti-fraud system built from wood. No passwords, no encryption, just 2 pieces that had to match. These records of debt could sometimes be transferred, allowing the claim itself to move from one person to another. That idea should sound familiar. A modern banknote is also a claim. A bank deposit is a claim. A bond is a claim. Much of the financial world is built not from piles of physical wealth, but from promises about who owes what to whom. In 17th century England, goldsmiths stored coins and precious metals for customers. They issued receipts for those deposits. Over time, people found it easier to exchange the receipts than to repeatedly withdraw and redeposit the metal. The receipt started behaving like money. The Bank of England, founded in 1694, issued notes connected to deposits and promises to pay. Early notes could even be written for unusual amounts because they were records of specific transactions rather than standardized bills. But there was a discovery hidden inside this system. Not everyone came to redeem their paper at the same time. That meant banks could support loans and claims beyond the physical cash immediately sitting in their vaults, as long as customers remained confident and withdrawals stayed manageable. This made credit more available. It helped finance businesses, trade, construction, and governments. It also created a permanent danger. If too many people lost confidence at once, the system could break. A bank might own valuable loans and assets but still fail if it could not produce enough cash immediately. Money was becoming faster and more useful. It was also becoming more psychological. For centuries, many people trusted paper money because it could be exchanged for gold or silver. The paper was not the final value. It was a ticket that could be redeemed for something considered more real. Gold seemed perfect. It was scarce, durable, recognizable, and difficult to create. But gold-backed money limited governments and banks. During wars, crises, and economic emergencies, that limitation became uncomfortable. Governments needed to spend more than their gold reserves easily allowed. Gradually, the connection weakened. In 1971, the United States ended the convertibility of official dollar holdings into gold, breaking a central part of the Bretton Woods system. The modern dollar was no longer a ticket another government could exchange for a fixed amount of American gold. The dollar became fiat money. Fiat does not mean fake. It means the currency is accepted because the government recognizes it, taxes are paid with it, debts are settled in it, and millions of people expect everyone else to keep using it. Its value comes from the system around the money, the economy, the law, the institutions, and above all, confidence. This is where the giant stone from Yap suddenly stops looking so strange. The dollar in your account does not need to contain gold. The stone did not need to move. Both worked because a community maintained a record and respected the transfer of ownership. Then money began disappearing from sight. Telegraphs, checks, payment networks, and electronic banking allowed value to move without physical currency traveling beside it. Credit cards pushed the idea further. When you use a credit card, you are not handing over money you already possess. You are creating a chain of promises. The merchant trusts the payment network. The network trusts the issuing bank. The bank pays the merchant and records that you now owe the bank. A piece of plastic triggers an invisible arrangement between institutions. And the plastic itself is not the valuable part. Cut the card in half and the account still exists. By the time banking moved onto computers, most money was no longer cash. It existed primarily as bank deposits, numbers in ledgers showing balances, debts, and claims. This created one of the most common misunderstandings about modern finance. People imagine money as a fixed pile of bills circulating from person to person. But when commercial banks make loans, they can create new deposit money. If a bank approves a loan and credits the borrower's account, the borrower now has a new bank deposit, while the bank records a loan asset and the borrower records a debt. New purchasing power has appeared inside the banking system. It is not unlimited magic. Banks face capital requirements, liquidity needs, regulation, risk, interest costs, and the possibility that borrowers will not repay. But it means that much of the money people use is connected to debt. Your bank balance may be your asset. From the bank's perspective, it is money the bank owes you. The system is a web of promises so large and normal that most people never notice it. Then, in 2008, during a global financial crisis that badly damaged confidence in banks, a person or group using the name Satoshi Nakamoto published a proposal for Bitcoin. The goal was electronic cash that could move directly between users without requiring a financial institution to approve every transaction. Instead of one central bank ledger, Bitcoin used a distributed network and a public transaction history protected through cryptography. Once again, the physical object disappeared. But trust did not disappear. It moved. Traditional money asks you to trust governments, central banks, commercial banks, laws, and payment networks. Bitcoin asks users to trust open rules, cryptography, software, and a distributed network. That does not make Bitcoin automatically safe, stable, or suitable for every purpose. Its price can move dramatically, accounts can be lost, and fraud can surround the technology. But historically, Bitcoin represented something important. Humans had created a form of digitally scarce value that was not issued by a king, printed by a central bank, or stored as a physical commodity. The argument over money had entered a new stage. Today, you may receive income by direct deposit, pay with a phone, borrow through an app, send money across a continent in seconds, and go weeks without touching a banknote. The money feels instant. The system behind it is not. Behind a simple tap are banks, identity systems, telecommunications networks, regulations, databases, settlement processes, cybersecurity teams, and layers of trust built over centuries. And every new form of money creates new winners and new risks. Shell money could be disrupted when outsiders arrived with enormous supplies of shells. Metal coins could be debased, paper could be overprinted, banks could fail, credit could trap borrowers, digital accounts could be frozen or hacked, cryptocurrency could be stolen through poor security or surrounded by speculation. The technology changes. Human behavior does not change nearly as fast. We want money to be stable, but we are attracted to opportunities promising fast gains. We want banks to protect our deposits, but we also want cheap and easily available credit. We want governments to support the economy during crises, but we do not want today's decisions to reduce our purchasing power tomorrow. Money is a constant negotiation between convenience and control, safety and freedom, trust and suspicion. And that negotiation affects your life even if you never study economics. Inflation determines how much your salary can buy. Interest rates affect credit cards, mortgages, business investment, and employment. Bank lending influences how easily new money and credit enter the economy. Payment systems determine who can participate. Financial habits determine how much of your future income has already been promised to someone else. The history of money is not a straight line from primitive objects to superior technology. It is a series of attempts to solve the same basic problem. How can strangers exchange value and believe the agreement will still matter tomorrow? Cowrie shells solved it with scarcity and recognition. Coins solved it with metal and official stamps. Paper solved it with written promises. Banks solved it with ledgers and credit. Cards solved it with networks. Digital money solved it with databases. Bitcoin attempted to solve it with cryptography and distributed verification, but none of them escaped trust completely. Even the most advanced financial system depends on people believing that balances are accurate, rules will be enforced, and someone else will accept the money next. That is why money can collapse without physically disappearing. The notes can still exist. The numbers can still appear on screens. But once confidence is destroyed, the object loses the invisible agreement that gave it power. And that is why the enormous stone money of Yap was not as irrational as it first appeared. The stone did not need to move because the community remembered who owned it. Your digital money does not need to move physically because banks and payment networks update who owns what. Thousands of years of financial innovation have changed the material, the speed, and the scale. But the basic mechanism remains almost untouched. Money is a story we agree to believe together. And the moment enough people stop believing it, shells become shells, paper becomes paper, and numbers become nothing more than light on a screen. So the next time you tap your phone to buy something, remember, you are not just using technology. You are participating in one of the oldest collective agreements in human history. And before you leave, there is a small golden coin hidden somewhere in this video. If you spotted it, comment the exact timestamp below and tell me which form of money you think people will trust 50 years from now.